Enjoyed the session with Jake. Today we have Chris Lee, and he is owner of the New England Capital Financial Advisors. He's a speaker for many Jumpstart conferences, does a great job, is a very interactive and engaging speaker with a lot of knowledge, and makes it really real for us as the attendees. And I always feel every session I attend with Chris, I leave thinking about something a little bit differently and taking something back to the classroom that can be useful. So with that, Chris, we'll pass it over to you. And again, if you are an attendee, we'll use the Q&A to communicate with Chris. And the chat is more of communicating with one another. And hopefully we'll have time at the end for questions.
Great, thank you. Hope everyone is doing well and being safe and healthy through all this stuff. So kind of the format for today is have about 5 questions I'm going to run through, take some time going through those. For those of you that have seen me before, I do love taking questions and stuff. So if there's some things that I don't cover today that you want to talk about, hopefully we have some time at the end of the day to kind of go over that stuff. So again, Chris Lee, I'm a certified financial planner. So I do have a background in investments, estate planning, employee benefits, taxes. So I do have a pretty round background in financial planning. So yeah, again, if there's questions at the end, we're going to go over some things about some markets today, some financial planning ideas. But then if there's questions at the end that you're thinking about as we go through some of this stuff, maybe you have some spouses or some loved ones that are going through some tough times right now with this whole COVID thing, be more than glad to talk about that. So the first thing I want to talk about is we have really low interest rates right now. So some of the questions I'm getting from clients is, should I refinance my mortgage or not? Generally, the financial planning rule of thumb is that if you can save 1% on your mortgage interest rate, it's a pretty good idea to refinance that mortgage. This graph shows the historic trend going all the way back to the 1970s for long-term mortgage rates. So you can see, although we've been low over the past couple decades, historically we've been higher. For those of you that were around in the 80s in Reaganomics, you may remember 17, 18% mortgages back in those days. And the lines on this graph that you can see show recessions that we've had. So it's kind of just showing where we are. Those are the break points on that. So we are near some historic lows for our mortgage rates. What's even more interesting is that our 30-year mortgage, right? I mean, our 15-year mortgage is pretty close to the same rate as our 30 years. So when I tell people to whether or not to refinance their rates, I'm definitely pushing them towards a 30-year mortgage rather than a 15. And why is that? And the reason is that rates are pretty close between a 15 and a 30-year, probably around 50 basis points, so a 0.5% difference, sometimes lower depending on the bank that you're going. And I just tell people, do the 30-year, but if you want to pay it off early, pay it off 15-year. I think we go through time periods like this where you get a plan put together, and then the plan goes on, and I going through this whole coronavirus thing where people are getting furloughed, or maybe their jobs are they're taking wage cuts. Furloughs is not untypical these days. So I think people sometimes the idea of getting into a 15-year or even a 10 to have it paid, but now you've tied yourself into getting that paid off with no redo. Banks, when you pay off your home, which I'll talk about, there's some good points to that. But when you pay off your home and you lose your job and you go to the bank, hey, look, I need an equity line to get through things, you're going to look for your job and the ability to repay the loan, which you're not going to have. So again, if you tie up all your resources into your house, the bank's not going to be able to turn around and give that money back to you for liquidity. So So again, push out the longer term. There's lots of amortization schedules online in your classrooms, kind of figure out what you need to do to pay it off in 50 years or 10 years, or however you want to pay it off, and try to stick to that schedule that you have. As long as you have a decent emergency account set up, 6 months in a really accessible account, I'm definitely okay with that. So in the past, I wasn't a huge fan of always paying off mortgages. We're at some low rates. That's another question I get is, should I invest or should I pay it off towards my home? So we have a couple things that we need to figure out first, whether we do that. And obviously the market's down right now, so now is a decent time to add. Are we out of it? I'm not really sure. We'll be talking about that for the next question, but getting back to the mortgage, we all used to be able to deduct a good portion of our mortgage interest off our taxes, but with our new tax law changes from a couple of years ago, the standard deduction is so high for people these days that mortgage interest that you were able to deduct, you may not be advantaged. A little bit of a sex appeal as far as a tax deductibility goes. But with that being said, I definitely prefer clients paying off their mortgage before they were. And why is, so if we strip out the mortgage payments, say your payment is $1,500 a month, and $1,000 or $300 goes to property taxes and $200 goes to homeowners insurance, that leaves $1,000 left over for interest and principal off your mortgage. Well, in order to have that $1,000 a month, you need to have $300,000 saved in retirement dollars in order to generate that $1,000 a month in income. So if you don't have that $300,000 saved to generate that income for your mortgage, a good way to think about it, that if your mortgage is paid, that's $1,000 less a month you need, and that's $300,000 less you need in investments to get you through retirement time. So that's just using a 4% rule of thumb. If you have $1 million saved up, that can generate $40,000 a year as long as you live, as long as it's a properly allocated portfolio. So again, if you don't have the $300,000, a great tool is just having that mortgage paid off, and it'll give you some more flexibility at retirement time. So again, the tax law changes. Again, we get back into the realm of, does it make sense to pay down the mortgage? Does it make sense if you have a lump sum right now to put it off your mortgage, or does it make sense to invest in the market? I've been telling clients, do a part and part, do part into the market, I think long term, and we'll talk about where the market is, I think long term it'll be fine as far as getting return on it. But I also know that you're paying down the mortgage and getting that paid off too. So good time to refinance. If you can save the 1%, like I said, couple notes you want to make today, even if it's a little than 1%, if it's 0.75, 25 basis points, I still think that makes sense. I am recommending people go back to their present banks first and ask them about a refinance, and they're cutting breaks on refinancing fees and interest rates as well. So go back to your current lender. I always encourage people to go back to their banks. Always check with credit unions. Their rates are really, really good as well. So check with them and then look at the differences between the 30-year, the 15-year loans and stuff like that. So that's my take on mortgage rates. So let's talk next question that is burning on people's minds these days, and I think the impact of this financial crisis on retirement accounts, and kind of putting historical perspective, which on one side, we haven't had a drop this quick, this fast. I mean, we've had recessions before where things have come down pretty quick, but the market dropped 30% pretty quick within a couple months, within a month. That's historically been unheard of. Now, we have had a nice pullback. We've had a bounce back of about 20% or so over the past several weeks, which has been nice. But from a historical perspective, again, the virus is different, and I'll talk about that. But from a historical perspective, if we go back to every downturn, the S&P 500, so the 500 largest U.S. companies, If we go back to their downturns about 50% or more over the 1930s, we've always had a recovery. So if we take a look at the slide and we go back for this first example, September of 1929 to June of 1932, the market decline was 86%. So pretty big back here, and through depressions. 1 year return after that, the market was up 137%. The second year was flat, the third year up 6%, the fourth year up 56%, and the fifth year following that market decline, the market was up 16%, or a 5-year average of about 35%. So that was one of the larger returns. Again, we were coming out of a pretty big drop of about 86%. If we go back to some that some of you may remember, if we go back to the dot-com bubble that we had in 2000, if you remember, the stock market was flying high, and any company that was had anything with .com at the end of it and was losing money on an annual basis, was going up in price. It just didn't make any sense. So we had about a 50% drop during those months. And then these are the subsequent returns after that. And you see that following that drop, there was a average return of about 17%. And the recent one we had market drop of 2009. March 9th was the bottom of that market, and we had a 1-year return after that of up 72%, up 18, 6, 15, 23, where we had an average 5%. So, we've been through these declines before. It's nothing new. So, I'm expecting that things are going to come back. I'm not so sure that we are out of the woods yet on this thing. I'm definitely surprised. There's a lot of financial people that are surprised that we've had such a huge run up of the markets. I mean, there's definitely a lot of gloom out there. They're expecting unemployment rates to hit 24%. And we're at 15%. The numbers came out this morning. And I think all of us we're trying to figure out when's business as usual going to be, and the market's trying to price that in. I think that the market's pricing in a vaccine that'll be coming out in the winter months, probably in the beginning of 2021. And I think the market's pricing in a solution that people that have coronavirus or in the hospital, a solution, 6 don't pass away. And I think that's the big risk right now. And I think that's, in my opinion, that's what the market is seeing in. So for now, my advice is we go through this stuff. So a couple things. One, I'm going to talk about the age group that have 5 years to go before retirement. And then I'm going to talk about the age group that has less than 5 years to retirement time and what to do. So the age group that has more than 5 years to retirement, I think letting things be where they are and hopefully you make any decisions when the market dropped that you've made changes in your account that are conservative. Nobody knows how to time the market. And I think I've been doing this for 26 years. And I think back to my busiest times that I've had in my career with the phone calls from my clients that are nervous and can't take it anymore. They can't sleep at night, tired of watching the accounts go down. And when my phone's busiest, right around the bottom, I've gone through this back 2000. I definitely went back through 2008, and I feel when we came near this bottom in March, around the end of March, my phones were pretty busy. So yeah, I think what's tough with this downturn is that as we're all working from home at this point, that we have a lot of time to turn on the news to see what's going on. And I think that, sensational news headlines are meant to grab your attention, and they do that. And I think it can be very dangerous to let the media influence your investment decisions. I tell people all the time, you have to ignore the noise and stay focused on your goals. What are we trying to accomplish? If you're retiring within 5 years, it's a little bit closer, and there's some things that we need to do, which I'll talk about. But for the other people that have 5 years to go, this is just going to be a bump in the road. This is America. We're resilient. We've been here before. Have we ever had a virus like this? I mean, think back to Ebola, and some of the other things. Was it as bad? Absolutely not. But you know what? We've also been through polio and some other things that were crippling to the country. So, you know, we've gotten vaccinations for that stuff. And I think that everyone's working together right now. And I think that, you know, all the scientists are working together to try to get a solution to this. And we've survived everything in the past, the things that we've been through in this country, whether it's wars or presidents assassinated or politicians we don't like, or, you know, we've been through all of this. And I think that we are going to get through this, and we are going to prosper. Now, I don't know, are we going to, you know, the question I get from clients, is this going to be a recovery? Is this going to be a W-shaped recovery, right? Because we always have to put labels on things. You know, is it going to be shaped like a W? Will the market be shaped like a W? Will it be an L? Will it be a V? Will it be a U? We go through all these things. And I think now we've kind of seen a V so far, that we've had a jump back up where, excuse me, it's only up about 10, 12% for the year. So things have really bounced back quite a bit here in the United States. That doesn't mean that we're not going to have a W where we could have another drop. I don't know. My own personal, again, this is my own personal opinions. I don't think we'll back down to 18,000 that we had, 18.2 on the Dow. I think that was really, really low. But we may have a little bit of a drop here point. I just don't know when it's going to be. The problem is, I don't know the whole vaccine and when solutions are coming out, and nobody really knows as to when this stuff is going to come out. I mean, somebody could come out tomorrow and all bets are off the table that we can have a vaccine out and distributed within the next 8 months, and that changes everything. All of us getting back to normal. Part of this that we have to remember is, though it's going through this, and I don't want to sound callous, but the mortality rate, and again, I think we're still trying to work through some numbers on some of this stuff. It's not 20% of the population that's passing away here. It's 2% of the population at the most, is from what numbers I've seen. So for the most part, as horrible as this stuff is, and as careful as we need to be, I don't see it as so morbid where it's going to wipe out. We're going to lose a bunch of workers that are contributing, that are adding to social security, making the payments into the program, contributing to GDP. You know, a lot of this, you know, unfortunate, as Darwin has said, it's been survival of the fittest, and we are losing a lot of people in nursing homes, and quite frankly, people that already have existing health conditions. So again, scary stuff that we're going through. I don't want to minimize that. Going through stuff here. My wife has MS, and I know that we have to be super careful with her, as some of the treatments that she's doing weakens her immune system. So I think we need to be careful, but I think we need to put things in perspective as well. So again, you know, try to shut the news off. I talked to a lot of people lately. It does get ridiculous. I don't know, we need the daily press conferences anymore and all that other stuff. So some of the stuff just doesn't help. So turn off the news on some of the stuff. Let's talk about the people that have less than 5 years. You know, I think the greatest risk for people that are retiring within the next 5 years, especially the next year or two, is sequence of returns risks. So, and what that means to your portfolio. And what I mean by that is, look, out of every 4 years, every 5 years, I know the market's going to be down one or two of those. I don't know which two they're going to be. This could be the year. Who knows that we're down? It could not. We could bounce back up again by the end of the year. So with that known, that your greatest risk, I think you have to make that transition and get your portfolio more conservative. So more bond type instruments, which quite frankly, some of the bond funds actually got hit a little bit during this downturn because we had some liquidity issues, which I could spend a whole hour on talking, but I won't, because I have some other questions. So getting your portfolio more conservative. So then my next question, I've had clients say, "Hey, Chris, I've you know, I was 100% in stock, 80% in stocks. You know, I know, you know, we usually tell our clients we should be looking at 40% of their clients that should be moved to bonds when we get close to retirement time, and especially through retirement time. So if you're not there yet, you know, I think this is a good opportunity. We have had a bounce back, maybe shifting some of the portfolio bonds. In case we do get in case we get this W type thing where we get another bounce down again, I hate to see to get out and get more conservative right now, which I think is a good idea. That putting everything into the money market account, because I think that, people start figuring this out and saying, oh, geez, Chris said we're going to get a W-shaped recovery. And all of the next thing you know, that we'll get the S&P 500 up 20% for the next couple of months. I've done this long enough and no one can figure it out. I don't care who the experts are. Nobody can figure that out. What I do know is we're going to have some volatility coming up. I think that from a volatility standpoint, we have this whole virus thing, and we're still trying to figure out the ramifications from it. But we also have an election coming up at the end of 2020 in November, which is definitely going to throw some gyrations in the market as well. I usually try to separate political risk from economic risk. I could do a whole nother session on that and the ramifications. I think as we get closer to the election, to see is Senate races and the House races, whether you like the president or not. Concern for me has always been the markets. When the houses control, whether it's Democrat, when all three, whether the House, the Senate, and the president, if they're all one party, the market does the worst. Whether it's Republican, right, it doesn't matter. The market is one of those split. So I think an eye on things, whether it's all three are Democrat or all three are Republican, the stuff to keep on it. We have some checks and balances in place that that one party doesn't take all three. So concern going into this upcoming election, as we, that will definitely send some gyrations into the market. The party is going to dominate all three of those. So again, you can take a look at that. So that is stuff I want to talk about now is actually I want to share a screen with you, kind of talk about the bear markets are but bull market full. And I think this graph, I love using this because it kind of puts things in perspective where it shows the bear markets are in red, and you can see the downturn, obviously the red on here that goes below zero. And you can see that in this example, we've had, I think there's 9 on here, 10 on here, that we've had going back to 1949, but it gives you perspective. Bull markets run, that these markets are eventually we do make this stuff up and we do come back. So that is it's important to put that in perspective here and take a look at these bear markets. They're not forever. They may feel like it when we're in here, but they're definitely not forever. All right, so my next question is, oh shoot, I have another slide on here. What's held up? This is good, actually. I do want to talk about. So what's held up well? If we go back from February 19th till April 7th, when we had this huge, what's done? Our consumer staples. Right? Everybody was out buying Clorox bleach, and we're continuing toilet paper. God knows people are going to have to buy toilet paper for after this. All those consumer staples, people are out buying them. That didn't stop. We've lines at grocery stores and BJ's and Costco. That hasn't stopped. Care from kind of the market down to the bottom was down about 12%. Why is that? Of people on prescriptions are going to stop. Insurance companies aren't going to stop paying out claims, and people aren't going to stop their health insurance. So, the benchmark here, the S&P 500 index, was down 1%. So, respectively, those were down about less. Those two sectors were down about half the market itself. The other piece, IT, information technology, is down 19%. That's the whole sector. I mean, I think some stocks have held up a lot better. I mean, look at the platform we're using today, Zoom. You look at a stock price at $6 at the beginning of the year, and recently was trading around $160 per share. So, on that stuff. Other companies that have done well through Microsoft, Apple, those type companies as well. Utilities, people are still going to keep paying their electric bills and phone bills. That's not going to stop. Although they were not immune to some of this stuff, they were down about 20%. So what got hurt the most? Energy, which I'm going to talk about in a minute, explain as to why. Financials we're down about 30%. So people ask, why did financials get hurt so much? Banks are very much tied to interest rate risk. So when interest rates fall, that hurts their profit margin. So the Federal Reserve cut interest rates, and really, when they did that, it really hurt the banks, which is why financials were down. Industrials, I mean, a lot of manufacturing plants, maybe they've shown or maybe workforce at this point, so production has slowed down quite a bit if it hasn't stopped all. And then real estate has stopped. We're not looking for homes. I know we're doing virtual, where that's dropped, and I think people are starting to realize that they need to go to work from home. And then also the sensitivity of people not being able to pay their rent has dropped. The real estate market is. So those are the sectors that held up. Going forward, if people are worried about a second wave, I definitely think these top couple sectors are the place to be. They've definitely held up better. There's another second wave that's coming. Let's hope not. That's not as bad as the first, but I think that's a good reflection of where we can go to weather the storm. So that gives you some ideas on some of that. So I mentioned that oil was down 40%. So one of the questions that I got was, can you demystify, explain what happened to oil prices late last month and how there can be negative values for a barrel of oil? So what's crazy is if you take a look at our long-term oil prices here, we can see that through the 80s, we had some lower prices there, and then we had some huge jumps as we went through 2008 when the economy was booming. People were flying. There was a lot of consumption. Manufacturing was great, and then you can see through the downdraft that we had in 2008, the price of oil just through the recession, and then we started climbing back up again. And then obviously this recent drop down to some lows of $19 a barrel, and we did spike down to below zero at one point. So why is that? And I think that was kind of it was the perfect storm of everything coming together. So Saudi Arabia, who's the world's largest exporter, was in an alliance with Russia as far as producing oil and how much they were going to get out. And they had agreed on that it was going to be 2 million barrels a day that they were going to cut on, have their cuts, and that's the way that it's been for a while. So Saudi Arabia wanted to increase their cuts up to 3.6 million. So they basically want to double their cuts and have oil coming out, because they knew that with a slowing economy, this was the part of the perfect storm, is that people aren't driving as much. I mean, I filled up yesterday for the first time in like a month. It was just ridiculous, just running out to local grocery stores and not really driving a whole lot. Not a whole much to do. So consumption is down, and again, as most of you know, as your educators and teachers stuff, supply versus demand. We've had a ton of supply. It's been coming in. The U.S. government actually bought up a bunch of their supply here. Not a lot of demand. So what does that do? That drives the price down. The Saudis realized that. They decided they're going to cut how much that they're on the ground to try to stabilize the price, to raise it. And at that point, Vladimir Putin wasn't too keen with that, and he didn't want to go along with that. He didn't, he was worried about ceding too much ground to the American oil producers, and refused to go along with the plan. So they got into a little bit of a price war over there, and it just kept driving the price down and down and down. And because the Russians didn't want to cut consumption, and then before you know it, we had these oil tankers that are sitting out to sea, and we had no place to put it. We had no place to put it, and places were refusing it. I mean, refineries here have been full. There's no place to put it. So that's what kind of things to negative. And that's kind of where we're at with that. So, eventually I do think things will come back. I mean, producers here, we've run out of space. I mean, we're oversupplied. We're filled to the brim, literally filled to the brim, and no place to put it. So that's kind of why those prices drop down so much. You know, do I think that that's going to change? Yes, I think the recovery is going to pick up over the second half of the year as the restrictions on travel um, are lifted. So as people are starting to fly more, possibly travel more, go to different states, there'll be another demand again. I think once that demand, that'll take some pressures off. And then supplies will dwindle. We'll definitely start working down those supplies that we have. And then we'll need some more new supplies coming in to refill that. So that's kind of, I think, where we're heading at. I don't know how long that's going to take out in the price of oil. I do have you know, clients calling up asking to buy oil. I'm not huge jumping up and down. I don't think USO is an ETF that tracks that stuff. I think there's other better alternatives than to stick with this whole oil thing. Again, if we have another second wave coming through, I could kind of see that trend go back down again as to where it is. Again, no guarantees on that stuff. Oil as a commodity is just tough. That stuff can move all over the place, as you can see by that graph that I showed you, kind of where that stuff moves. Next question I have is general advice on using the stimulus money. So again, we had the $1,200 that we were sending out based on if your income stayed under a certain amount, and $500 per kid. So what am I recommending to clients right now with some of that money? So first and foremost, you know, if you've experienced furloughs or day off or reduced pay, man, I'm having people just build up their emergency accounts and in the bank and just make sure that, you know, 3 to 6 months in a readily accessible account. So if your monthly expenses are $3,000, then we should have, you know, $9,000 sitting in the bank for the unknown. Kind of see where we're going from there. So that's the first part that I always tell people to, and make sure we do that. You know, the next part is, you know, if we've satisfied that, I'm a firm believer in just paying down some non-revolving debt. So again, mortgage debt, I'm fine with. Car debt, it's a depreciating asset. Most car loans are at pretty cheap rates these days, under 4%, 5%. Not a huge rush to pay those down. But you know, if there's any credit cards out there, you know, work on paying that stuff down. I've had people say, what if I have doctor's bills or dentist bills that I'm paying a monthly balance on that? Most of those get 0% interest rates. I'm not keen on paying those down right away if you're at 0% there, but definitely the credit card debt, definitely get that stuff done. Maybe there's some unsecured loans that maybe you've done through a credit union or a bank. You pay those down as well. And I think, you know, once we're looking past that stuff, we've extended, so the CARES Act has extended the tax filing deadline to July 15th, which is great. So even if you guys have filed your taxes already, it's not too late to, as long as you meet the under the income threshold. For joint couples, it's 105,000 this year. Single, it's 100,000, somewhere around there. I'm rising, but they index it with inflation every year, so it changes. Make contributions to your Roth IRAs for 2019. I think it's a great idea. If you're over 50, you can do 7,000, and if you're under 50, you can do 6,500. So again, I love taking advantage of that. It's tax-free money, gross tax deferred, never pay taxes on it. You have till July 15th to make those contributions. So that's pretty much what I'm saying at this point, is to help out with that. You know, cash is definitely helpful going through this. I have had a lot of parents that I've been talking to that they need to help out their kids who are maybe laid off or either have maybe moved back home or struggling with rent. So obviously keep that in mind as well. I know that that's it. Again, that goes back to having a great plan, and then we get punched in the face, that whole plan goes out the window. But I think those are some good things to think about. Historical lows for the market. You know, I think it is a good time to. You know, the markets are still down for the year. I think it is a good time to add to Roth IRAs to get the money invested into the market. You know, Roth IRAs, I'm not a big fan of putting into CDs and cash because you're barely getting any interest on that. And the whole bang for your buck on Roth IRAs is tax deferred and tax free when you take it out. So we want our money to grow and to double and to triple in size. And it's never going to double or triple. And you know, in safe money market, it's going to take you 20 years at these rates to get the money to double. It's crazy right now, some of these rates that I'm seeing with such low interest rates. I'm actually seeing higher rates on money on CD rates for 1 year than people going out 2 year on CD rates. It's absolutely nuts right now, but that kind of shows you where we're at. So my last question before we open this up for questions is, question was about taking money out of retirement funds to deal with this or any other crisis. So part of the CARES Act, what it did was it took the waiver of the 10% penalty, early distribution penalty. You took money out of your IRAs. We'll strictly talk about IRAs for a second. You took money out of IRAs before age 59 and a half. There's a 10% penalty as long as it was qualified. And right now, having COVID, if you get COVID and you're out of work or taking care of a loved one with COVID, you're exempt from that 10% penalty. It's still taxable, mind you. So if you take out $10,000 in an IRA, you miss the 10% penalty. But if you're in the 15% tax bracket, the state income tax of 5%, just know that you'll pay 20% in taxes. And then another thing they let you do is that tax liability. They are letting you spread that distribution over a 3-year period for tax purposes. So if you take out $10,000, each year will be taxable $3,333 per year for three years, and you just pay the taxes each year on that. 401k plans, you were limited to taking out 50% of your account balance or 50,000, whatever is less. That was always the old rules. That's a loan. That's not a withdrawal. That's a loan that you could borrow from the account. They just increased that to 100,000 or 100% of the account balance for loans made during the 180-day period beginning March 27th, 2020. Then any loan repayment normally due between that date and December 31st could be suspended for 1 year. And just remember that IRAs do not let you take out loans. That's strictly with the 401ks that you can take out the loans. So people ask me, should I be taking it out? I always count that as the last resort. And the reason that I do is that, you can't spend the same dollar twice, and that, every action has a consequence. As I remind my teenage children who are now home from college and decided to change all their classes to pass fail, but every action has a consequence. So just realize that you can't spend the same dollar twice. Obviously if it's an absolute emergency and you're going to get evicted, definitely, that may be the time where it makes sense to do that. Especially more with the IRA distributions. The 401k loans, it's a loan that you're putting back, you're paying yourself back. I think the sucky part of taking out a loan against your 401k now would be that if the market bounces back up nice, you're going to miss some of that growth. Money is out of the account. It's not in there earning dollars while you're taking it out and paying yourself back the interest rate of 3-4%, whatever it is. You're definitely missing the growth on that. So again, I definitely would take a look at all those avenues of getting through. I tell people, especially now, if you're in a tight spot, always call out, reach. If you know someone that's going through issues with their mortgage, car loan, call these people up, have conversations with them, be honest with them. They want to hear from you. A lot of these will go into forbearance where, yeah, you'll have to make the payment up and maybe they'll amortize it and spread it out, but at least they'll let you skip a month or two to go back to work. I mean, look, let's face 25% of the country will be unemployed at some point. So it's going to affect all of us. We're going to know someone or be that person affected that's going through this stuff. And the banks know it, the lenders know it, and benign neglect doesn't do any good with that stuff. I always tell people to don't stick your head in the sand, be proactive with it, get out in front of it, do it. Some of the nice stuff too. So if you guys are dealing with friends or yourselves going through the student loans, that they can go into forbearance. You don't have to make payments. They have to be federal loans. They're not private loans. So stuff like Sallie Mae is not exempt. It's only federal loans that we can defer payments to the end of the year, and there's no interest that's accruing on that stuff too. So there are some programs out there. Just do some research on the CARES Act. If something that may apply to you, because I know it reached out to a lot of people. So those are pretty much the questions that I had. I know it's about 11:40, so we have some time. So Brett, Emma, I'm not sure if we've had any questions that have popped up that I can answer through this.
I definitely have a question. I really appreciate all the information you shared, Chris. And hopefully it will generate some more. So if you want to ask a question, just throw it in the chat or the Q&A and we will try to get to it. But thinking about what you just shared about the CARES Act and all these breaks that people can access, and we see more and more of those, whether it's a student loan deferment or taking money out without a penalty. I feel like these are all short-term breaks with really high consequence long-term actions potentially. You know, even the mortgage or the missed rents or all these other things that are going on.
Yeah.
And so I guess what I would love to know from you is, how do we help kids understand that? How do we help them understand these things are happening kind of, and also help them have hope in their future?
Yeah. You know, I think that a lot of this is short term. This is going to be a long thing. We're not going to be living with this forever. As we get close to things, be short term. And I agree with you, Brett. I mean, there's, you know, we're just at the beginning of this, and people getting behind in their rent payments or whatever it's good. I mean, look, let's face what the Federal Reserve did is they basically put enough money and stimulus out there in a CARES package that they replaced 8 weeks of GDP. That's basically what we've done. We've said, okay, we've known we've lost 8 weeks of GDP. Nobody's working. You know, not everybody. Some people are still working, but there's a lot of places that have shut down. So it kind of temporary. All this spending, I mean, I don't know about you guys, but you know, we're not going out to eat as much. We're not doing certain things with the kids. We're not going out, and all that money has been accumulating in our accounts. Granted, there'd be a portion of the economy that aren't working 5%, but the other 75%, the stuff's accruing. And guess eventually people are going to go back out to travel. They're going to do their trips, and they're going to Disney, and they're going to do a cruise. But Americans don't, for the most part, they save some. For the most part, they'll spend 98 cents on the dollar if they can. So there's going to be, and I think the market is kind of banking on this. So there's a lot of built up demand that I think is going to help get us through this when it comes again. So I think they're at the end tunnel. We haven't destroyed a lot of wealth. We're saving some wealth now. I mean, yeah, some has been destroyed that we'll never get back. I think if you think about, if you go to Starbucks once 5 days a week and you haven't been in 3 weeks, you're not going to order 17 cups of coffee when you go back. That's just not going to happen. That's been destroyed. And those are revenues that Starbucks will never ever get back. You know, so again, I think there's part of it has built in that's been destroyed, but I think there's a big part of this that is up, and you're going to have some big parties when this whole thing ends. That's for sure. So, does that answer your question?
It does. It does. Okay. I like that. You know, that 8 weeks of GDP and be able to share that with kids. It kind of gives a good perspective and not a huge. It's not overwhelming. They can understand.
Yep. Absolutely.
Oh, here we go. We've got another question. Let me just read it. Thoughts on positive market fluctuations despite the continually bad economic signals?
Yeah, that's a tough one. You know, I mean, before we came into this whole Corona thing, the economy was going phenomenal. We had low unemployment, historic lows. We can have some discussions whether we think things were overpriced or not as far as a bubble, but I do think the economy, look, the Fed has two mandates. It's low interest rates and low unemployment, and we were doing that. And we had those, and I think we had very slow growth, faster growth as the president would have liked. Slow growth, which is okay. It keeps inflow and it kept unemployment low. So coming into this, I think things were good, and I think that's what we're seeing with the market right now. Knowing that we weren't coming into this with a huge bubble. I think that, you know, I look at all the things that. What can go wrong? What keeps me up at night? The banks are more secure than they ever were. I think some of the legislation that came out with Dodd-Frank that got passed after 2008, I think that it was, some people say it was an overkill, but the banks are more stable than ever. Their balance sheets look phenomenal. I think that's a huge staple right now of things that are helping us. The Federal Reserve has also added a lot of liquidity to the markets where they're offering money to people that need it. And they're also offering up to be able to back corporate debt as well. If corporates feels like they're going under, which is huge. And I think that's what's helping the market at this point stabilize and possibly go up. From here, we could bounce around this for a little bit. We could go down another 5–10%. I think long term over the next 12 to 18 months, I think the trend will be up, but you're going to see gyrations between now and then. What I am cautioning people is that be very careful with individual security selection. Certain prices of companies are low for a reason. There's a reason why Carnival Cruise Line and American Airlines and Southwest are beat up as to where they are. I liken this up to 2008, where General Motors went out of business. And if you own stock in General Motors, your investment went to zero. But if you own Ford, you're okay. So just diversify. I don't think I would be shocked if one of these cruise lines did not make it out of it. I would be surprised if one of these airlines did not make it out of it. I think there'll be a consolidation. Somebody will go out and buy 10 cents in the dollar. I think you need to look at what you're doing as we teach our kids, look at balance sheets, income statements. I mean, none of these cruise lines are having revenues coming in and they have quite a few expenses. Carnival is still building 3 boats that they need to that they finance, they need to pay. So there's pockets. So I do think the trend will be up over the next 12 to 18 months, but I think we're going to have volatility with a possible second wave. People are getting a little euphoric and getting back to normal, which we shouldn't be at the moment. And the election come up, there'll definitely be some volatility from here on out. Yep.
Awesome. Well, you've touched on some of these other questions that have come up, but let's start with them anyhow. With rates low, and if your job is secure, is this a good time for a car loan or a mortgage?
Oh, if your job is secure, I absolutely do think it's a good time for 2 different issues. So mortgages, houses for the most part are appreciating assets. So I'm definitely fine with the mortgage. I think it's a good time, especially if you can have a 20% down payment where we're not paying that PMI, the principal and mortgage interest. And if you do happen to pay the PMI because you have less than 20% deposit, just kind of put a plan together to get rid of that as soon as possible for the extra couple $100 a month, whatever it happens to be per month. Work on that. Car loans, we are at historic lows. I think that a lot of these dealerships are going to be pushing to get their cars out, and I think you're going to see a lot more deals, probably more towards the summer months. I mean, as we all know, when do 2021 cars come out? Do they come out in 2021? No, they start coming out in the fall. So what's going to happen is those newer cars will be coming out, and these dealerships will be forced to get rid of their older models, brand new cars, but older models. So yeah, I'm not opposed to that. Again, I think with car loans, if you can get 0% interest, phenomenal. Sometimes I tell clients, trying to reach for a down payment at 0%. I don't even know how much money I'd put down for a car loan at 0%. I mean, if it's a depreciating asset, why take something you could get at 0% and plop it down on a car? But it goes back to managing expectations for car loans and what you're doing. Everybody has their own way they work about it. I mean, I've always been convinced I'm always going to have a car payment no matter what, just because it's an appreciating asset. So kind of like we've done in my household is that once a car, we only have one car payment. So once that other car payment gets paid off, then the other spouse can buy the car and start the car payment back up again. So it kind of gets everybody getting a new car, once every 5 to 6 years or so, and only one car payment to deal with as we go through this stuff. So that's kind of what I do personally. It seems to work. Some people say, well, I've never had a car payment. I'm like, well, you've also saved up each month not to have a car payment. So either way you look for it, you're saving up to get that car payment at some point. So that's kind of what we've done here. Yeah.
All right. So we've got 2 more. Could you explain the extent of the Fed's QE efforts? I think it's a quantitative easing.
Yep.
Are they purchasing high yield corporate bond ETFs or other equities?
Yep. As of now, they're not purchasing the high yield corporates. I mean, it's a concern. They've opened up the checkbook quite a bit. And we had some liquidity issues earlier in the year, and I think the Fed, and I'm usually, in all full disclosure, I'm usually not a fan of the Fed. I usually think they're late to the party. But this time, I think they've done a good job in opening liquidity. We ran into some issues. I was nervous. The second week of February, I was really nervous. We had liquidity issues. I saw municipal bonds at decent prices getting sold for nothing. So usually the ultra rich will have some of these things in their portfolios. And what happened was the really rich people, I'm talking about, the top 5% of Americans own these things. They were selling because they were worried about a liquidity issue, because they have a lot of properties, they have a lot of other investments, they have a lot of needs that they recognize things were going to get tough and they needed to raise cash. So they were selling some of these things. The Fed came in at that point, granted some liquidity to some of these things, which was fine. And more importantly, some short-term loaning the banks do overnight. A lot of stuff we don't see that happens overnight. Banks sometimes will need X hundreds of million overnight to make their balance sheets look good and keep in line with Dodd-Frank. Happens all the time. So that stuff was warranted and it was needed, it was fine. But as of now, they're not buying any of those high yield bonds, or definitely not equities at this point. That hasn't happened. And I don't see that happening. I really don't. I hope that doesn't happen.
All right, last question before we have to transition. In a down market, should we consider making some investments on things that have dropped that should be making a recovery? On the other end, is it a good time to make an investment if we have disposable income to do it?
Yes, but be careful of the sectors. So I kind of talked a little bit, there's, again, my own personal opinion, we could come back 6 months from now and oil could be at $40 a barrel. I just like to place, I hate using gambling as a metaphor, but sure bets. I think whether it's information technology, healthcare, stuff that we know will hold up okay if we get a second wave. I'm not so sure. Real estate, long term, I think we'll be fine with some of that stuff. Oil, I think long term, it'll bounce back up again. Hotels, airlines will bounce back up again, but I think there's going to be other opportunities between now and before those bounce up to take advantage of. So yes, I do think it's a good time to invest, whether it's an index fund, maybe an S&P 500, something like that. I definitely just want to go bottom fishing for I don't pick a Carnival or Royal Caribbean or American Airlines or Southwest. I definitely want to go bottom fishing for one of those because I'm not so sure that's going to work out well. Some of those will be fine. Well, like I said, we'll come back in 6 months and Chris said not to get Carnival, and now it's up to $50 a share. I know one of those are going to happen. I just don't know which one it is. I'd rather stick my money in a company like Microsoft or like a Disney that, yeah, Disney has revenues tied to their theme parks and their cruise lines, but they also have Disney Plus and ABC and ESPN. So again, don't just take a look at one company, what they do, look at all the different things that they get into as well. So definitely, if we go back to that screen, and I think the slides will be available, they'll be available to some of those sectors I think that I outlined that held up well during this downturn, because I'm not so sure we're done with this downturn 100%.
Awesome.
Yeah.
Well, Chris, thank you very much for taking the time to speak with us today. I know I found it very informative and beneficial. I've got a lot of questions going in my head and thinking about how I can take what you've shared into my classes next week and help the kids out.
I'm glad I was able to help. It was definitely, this is a little weird. I think as people go through this stuff, this was my first virtual one that I've done as a session, and not seeing the expression on people's faces or, seems shaking their head or yes or no. And from there, it's kind of tough, but I'm glad people got to ask some questions. And if there are questions after this, if people want to send that, I'd be more than glad to reply via email, or even want to pull me aside and do a phone call. I'm more than glad to talk to people.
Great. All right. So for everybody at the conference, we will switch over to the